Hello there, I'm James, and in this video I'll attempt to explain how journal entries work in less than 2 minutes. Start the clock. What is a journal entry? A journal entry is a record of a financial transaction in an accounting system. By financial transaction, I mean an event that involves the transfer of money or monetary value. What does a journal entry look like? At the top, we have the journal number. This is unique to the transaction and allows us to track it. To the left, we have the posting date, which lets us know the accounting period that the transaction falls in, followed by the accounts impacted by the transaction, a short description which explains its purpose, and then we have the debits and credits, split into 2 columns because in double entry accounting, there are 2 equal and opposite sides to every transaction. Debits go on the left and credits go on the right. As a sense check, the total of the debit column must always equal the total of the credit column. When we post a journal entry, we take all this information and record it in our accounting system. Allow me to explain with an example. On May 15th, Legolas Legal Solutions provides consultation services to Pippin for a fee of $2,000, which they pay for in cash. This is a financial transaction because it involves the transfer of money in the $2,000 cash and monetary value in the services provided. So let's record this in our accounting system using a journal entry. First, we want to give it a unique journal number to identify the transaction, 1121. Then we want the posting date, which is the date that the transaction took place on. That's May 15th. A brief description. Legal services for Pippin shall do. Now, which accounts were affected by this journal? In double entry accounting, every transaction affects at least 2 accounts. On the one hand, Legolas Legal Solutions received $2,000 in cash. So we need to increase the cash account on the balance sheet. Cash is an asset, which means it's a normal debit account. So debits increase cash and credits decrease it. For this transaction, we need to debit cash in the left column of the journal entry by $2,000 to increase it. On the flip side, we need to record an increase in service revenue on the income statement because the business earned $2,000. Service revenue is a type of revenue, so it's a normal credit account. That means credits increase service revenue and debits decrease it. So we credit service revenue in the right column by $2,000 to increase it. As you can see, the total of the debit column matches the total of the credit column. Happy days! Now we can post this journal entry into our accounting system. We can visualize this using T accounts. We need one for cash and one for service revenue. Let's say the opening balance of the cash account was $10,000, and for service revenue it was $5,000. These numbers have been brought forward from the previous accounting period. Now let's post the journal. First, we debit the left of the cash T account by $2,000, which increases its balance to $12,000. Then we credit the right of the service revenue T account by $2,000, increasing it to $7,000. I have put together a journal entries cheat sheet, which you can find and download right here. And if you'd like to learn more about accounting, then why not give this video a watch next? And I'll see you there.